MGM and Caesars were busy squeezing resort fees out of tourists and turning Las Vegas into a luxury theme park for billionaires, one man quietly engineered the single biggest locals casino deal in Vegas history, $31.5 billion. Not for the Bellagio, not for the Venetian, for the casinos your neighbor goes to on a Tuesday night. And the man who pulled it off isn't even from Vegas. That's what makes this story so extraordinary. Hi, my name is Michael, and this is Old Vegas Legends. Who is Tilman Fertitta? The man behind the money. If you don't know Tilman Fertitta, you need to. This isn't some Wall Street hedge fund guy who read a report and decided casinos looked interesting. This is a self-made operator from Galveston, Texas, who built one of the most underrated hospitality empires in American history. Fertitta was born in 1957 in Galveston, a Gulf Coast city that most Americans couldn't find on a map. His family had deep roots in the restaurant and entertainment business. His cousin is George Mitchell, the Texas billionaire who essentially invented the modern natural gas fracking industry. An understanding that people will spend money on food, entertainment, and hospitality if you give them a reason to. By the mid-1980s, Fertitta was already building. He took over a struggling seafood restaurant in Galveston called Landry's Seafood House and turned it around. Not by reimagining the concept, not by hiring celebrity chefs. He turned it around by understanding operations, by cutting waste, by training staff, by making the customer feel like the money they spent was worth it. In practice, it's the rarest skill in hospitality. By the time Landry's Incorporated went public in 1993, Fertitta had already demonstrated what he was about. Acquisition, integration, operational discipline, repeat. He bought struggling concepts, fixed the fundamentals, extracted profitability, and moved on to the next target. The list goes on until Landry's had grown into a portfolio of over 600 restaurants. In 2010, Fertitta took Landry's private in a leveraged buyout worth approximately $1.3 billion. He bought his own public company with borrowed money. Because he was that confident in his ability to run it better without Wall Street looking over his shoulder every 90 days demanding quarterly growth, that's the mentality you need to understand before we talk about station casinos. This is not a passive investor. This is not a financier playing with other people's money. This is an operator, probably the most disciplined large-scale hospitality operator in America, making a calculated bet on a specific theory about where Las Vegas is heading. And his theory is simple. The Strip is dying. The locals market is not. The station casino's story. What Fertitta is actually buying. To understand why this deal is genius, you need to understand what station casinos actually is. Because if your only mental image of Las Vegas is the Bellagio fountains and the neon glow of the Strip, you've been missing the real Las Vegas your entire life. Station Casinos was built on a completely different philosophy than the Strip properties. Frank Fertitta Jr., and again, no relation to Tilman, absolutely zero. They just share a last name and apparently extraordinary business instincts, founded the company in 1976 with a single property called The Casino. His sons, Frank Fertitta III and Lorenzo Fertitta, eventually took over and transformed it into something remarkable. 700,000 people live in the Las Vegas Valley. They have jobs, they have Tuesday nights, they have birthdays and anniversaries and just got paid Fridays. And they do not want to fight tourist traffic on the Strip, pay $15 to park. Station casinos built for those people, the locals, the residents. The people who make Las Vegas their actual home and treat the casino not as a once-a-year spectacle, but as a neighborhood amenity. Think of it like the difference between a tourist trap restaurant on a busy waterfront and the place every local knows about 3 blocks inland with half the price and twice the quality. Station understood that equation and built an entire company around it. Red Rock Casino, Resort and Spa opened in 2006 and it was a revelation. This wasn't a budget locals joint with sticky floors and cigarette-stained ceilings. This was a genuinely beautiful resort with serious amenities, real restaurants, a legitimate spa, and a casino floor that respected its players. It proved that serving locals didn't mean lowering standards. It meant delivering value consistently rather than squeezing visitors who'd never come back anyway. Each property positioned within driving distance of major residential neighborhoods, each calibrated to the community it served. Locals facing bowling alleys, movie theaters, restaurants with actual reasonable prices, free parking, always free parking. Because the people who live here aren't tourists. They remember, and they come back. Or they don't. By 2024, Station Casinos was operating as Red Rock resorts on the public market, generating revenues north of $1.9 billion annually, with an EBITDA margin that made strip operators quietly jealous. The locals market wasn't a consolation prize. It was a machine, and Tilman Fertitta decided he wanted that machine. Why the locals market is the secret gold mine nobody talks about. Here's what the major strip operators have spent 20 years pretending isn't true. The locals market is more profitable and more sustainable than the tourist market they're obsessed with chasing. Let me explain why, because this is the heart of the entire deal. When a tourist comes to Las Vegas, the casino has to acquire that customer. Marketing costs, advertising costs. The casino has to spend money to get them back every single time. New promotions, new attractions. That, as one travel agent put it in a report we covered previously on this channel, you can get cheaper than Las Vegas when you factor in value. When a local comes to their neighborhood station casino on a Wednesday night, the acquisition cost is nearly zero. They drove 7 minutes. They came because it's there. They came because last Wednesday was fun. They came because their friend called and said, "Come meet me at the bar." The casino doesn't need a Super Bowl commercial to get that person through the door. They just need to not mess it up. And here's the beautiful compounding effect. Locals visit more frequently. A tourist might visit Vegas once a year and spend $1,322 per trip, which is the 2024 average according to the Las Vegas Convention and Visitors Authority report we discussed. But a local might visit their neighborhood casino 30 times a year, spending $50 or $60 per visit. Run that math. That's between $1,500 and $1,800 annually from one customer who lives 7 minutes away and costs almost nothing to retain. There's another factor that nobody on CNBC seems to want to discuss. The locals market is recession resistant in a way the tourist market is not. When economic anxiety rises, people cancel vacations. They don't fly to Vegas from Cincinnati when they're worried about their mortgage. But locals don't cancel their Tuesday night. That's not a vacation. That's unwinding after work. It's a completely different psychological category of spending, and it holds up in ways that destination tourism simply does not. Local casinos in the Las Vegas Valley saw up to 50% revenue increases in recent periods while strip properties were bleeding. 50%. While Caesars was watching its net income crater 40.4%. Despite revenue gains, the locals market was quietly printing money in the suburbs. Tilman Fertitta didn't stumble onto this insight accidentally. He spent 40 years in the restaurant and hospitality business, understanding exactly this dynamic. The neighborhood regulars who come back 30 times are worth more than the one-time visitors who post on TripAdvisor and never return. Now he's applying it to the biggest locals casino footprint in Nevada. The numbers that made this deal impossible to ignore. Let's talk about what $31.5 billion actually means. Red Rock Resorts, the public entity that operates station casinos, had a market capitalization before deal discussions emerged that suggested something in the range of $5 to $6 billion. So, how do you get from $5 billion in market cap to $31.5 billion in deal value? That gap is where the real story lives. The answer is debt, real estate, and a theory about what this asset is actually worth to the right operator over a long time horizon rather than the next quarterly earnings report. Station Casinos owns, and this is crucial, owns the land under most of its properties. In a city where real estate appreciation has been extraordinary, and where the cost of acquiring new gaming licenses and suitable locations has become nearly prohibitive, that land ownership is an asset that public market investors chronically undervalue. They're looking at EBITDA multiples and cash flow yields. They're not pricing in the 30-year optionality of owning large format real estate parcels in one of the fastest growing metropolitan areas in the United States. Las Vegas's population grew from approximately 1.4 million in the year 2000 to over 2,300,000 today. It is still growing. Every new subdivision, every new master planned community, every new neighborhood that appears in the valley is a potential customer base for a nearby station property. The locals market isn't static. It's expanding with the city itself. The deal structure involves Fertitta taking the company private, assuming its existing debt load, which had been a concern for some analysts, and betting that his operational expertise can extract profitability that a publicly traded company, answerable to quarterly growth demands, structurally cannot. He's done this exact thing before. In 2010, with Landry's, he knows what a company looks like when it's being managed for Wall Street rather than for long-term value creation. And he knows how to fix it. Red Rock Resorts was generating revenues of approximately $1.9 billion annually with strong margins. At the valuation implied by the deal, Fertitta is paying roughly 16 to 17 times EBITDA. That's a premium. That premium reflects what the asset is actually worth rather than what a public market, obsessed with near-term earnings, was willing to price it at. Wall Street is watching. And frankly, Wall Street is a little confused, which, if you've followed Fertitta's career, is exactly where he likes them. The UFC connection. Why this family name already owns Vegas. Here's where the story gets genuinely fascinating, and I promise I'm not going off on a tangent here. Frank Fertitta III and Lorenzo Fertitta, the same brothers who built Station Casinos, also bought the Ultimate Fighting Championship in 2001 for $2 million. They sold it in 2016 for $4 billion. That is not a typo. The UFC was a struggling, nearly bankrupt, widely ridiculed organization when the Fertitta brothers and Dana White acquired it. Critics said mixed martial arts had no future. Mainstream sports media dismissed it. It was banned in most of the United States. The Fertitta brothers and White rebuilt it from the ground up. They got it on television. They built the brand systematically, fought for legitimacy, and created one of the most valuable sports entertainment properties in the world. The exact same playbook they used on Station Casinos. Take an undervalued asset. Apply operational discipline. Build the brand. Extract the long-term value that short-term thinking left on the table. Tilman Fertitta watched all of this. He's not a passive observer of the Fertitta name's track record in Las Vegas. He understands, perhaps better than anyone outside the family, what that blueprint looks like when it's executed properly, and he is now applying his own version of it to the asset the Station Fertitta brothers built, and a combined track record in Las Vegas that is, at this point, almost unfair to everyone else trying to compete. What Tilman Fertitta sees that everyone else is missing. Let's be very direct about something. While MGM was raising resort fees twice in the same calendar year, while Caesars CEO Tom Reeg was openly telling analysts they were deliberately eliminating lower-end customers, while the Strip was busy transforming itself into a luxury enclave that regular people increasingly can't afford, someone had to be paying attention to where those displaced customers were going. They were going to Station Casinos. When a middle-class Las Vegas family decides that the Strip isn't worth it anymore, when the resort fees and the $25 cocktails and the $50 minimum blackjack tables make them feel like suckers rather than guests, they don't stop going to casinos. They drive to their neighborhood station property and play where they feel respected. Fertitta sees the Strip's strategy of chasing whales not as their strength, but as their vulnerability. Every tourist they price out is a potential local's casino customer. Every resort fee they add is another reason for a Henderson family to stay on their side of town. Every time a Strip casino closes a buffet, tightens the slots, and replaces a dealer with an automated table, Station Casinos gets a little bit stronger by simply continuing to do what it has always done. There's a term in business called competitive moat. It describes the structural advantages that protect a business from competition. Station Casinos has 3 of them simultaneously. Location, because their properties are embedded in residential neighborhoods that new competitors can't easily enter. Loyalty, because locals who find a casino they like become extraordinarily habitual about returning. And real estate, because they own land in a city that keeps growing. Fertitta has spent his entire career building businesses with strong moats. Landry's built moats through sheer scale and brand diversity. Own enough restaurant concepts, and you're impossible to avoid in enough markets to sustain the whole portfolio. Station Casinos has a different kind of moat, but Fertitta recognizes the structure immediately. He's fluent in this language. And here's the part that I think is genuinely underappreciated in the coverage of this deal. Fertitta is making this move right now. At the exact moment the Strip is most vulnerable, at the exact moment visitor numbers are falling 11.3%. At the exact moment regular players are loudest about feeling ripped off and undervalued. He's not buying at the top of a cycle. He's buying when the alternative, the Strip, is actively accelerating its own decline. That timing is not an accident. That's a 40-year operator who knows exactly what he's looking at. The Landry's blueprint, how he's done this before. If you want to understand what Fertitta is going to do with station casinos, study what he did with Landry's after taking it private in 2010. Because the playbook is remarkably consistent. Step 1. Remove the quarterly earnings pressure. Public companies manage to 90-day cycles. Every decision gets filtered through the question of how it looks on the next earnings call. This creates a systematic bias toward short-term extraction over long-term investment. Raising prices looks great on a quarterly report, until customers stop coming. Cutting staff looks great until service deteriorates and occupancy falls. Tilman Fertitta took Landry's private specifically to escape this trap. Station casinos going private accomplishes the same thing. Step 2. Standardize operations and eliminate waste. Fertitta is legendarily disciplined about operational costs. Not in the way that Strip casino executives are disciplined, which is to say, cutting customer-facing value to boost margins while hoping nobody notices. In the way that a restaurateur who started with one seafood shack in Galveston is disciplined, which is to say identifying every dollar of waste in the back of the house so you never have to cheat the customer at the front. Step 3. Stack and leverage the brand portfolio. Landry's restaurants, the Golden Nugget casinos, the hospitality properties, they don't operate in isolation. They feed each other. A Golden Nugget hotel guest gets incentives to visit a Landry's restaurant. A Landry's Rewards member gets offers for a Golden Nugget stay. The portfolio creates a loyalty ecosystem that's worth more than the sum of its parts. Expect Fertitta to build similar bridges between his existing hospitality footprint and the station casino's customer base. Step 4. Look for expansion when the business is stable, not before. Fertitta doesn't overextend. He doesn't build a 67-story tower on the wrong end of the Strip and then spend 14 years watching it serve as the most expensive ghost in Nevada's real estate history. We've all seen how that turns out. He grows when the foundation is solid and the capital structure supports it. The station casino's portfolio has untapped development land, potential for new properties in growing suburban corridors, and a loyalty program that could be significantly deepened with the right investment. Fertitta will see every one of those opportunities. The question is which ones he pursues first and how fast. The risks nobody is talking about. Now, I've spent a lot of time explaining why this deal is smart. Let me spend a few minutes being honest about where it could go wrong. Because nothing in Las Vegas is without risk, and anyone who tells you otherwise is trying to sell you something. The debt load is real. $31.5 billion is an enormous number, and a significant portion of that deal value is debt, both assumed and new. Interest rates in the United States, while down from their peak, are not at the historically low levels that made leverage buyouts in the 2010s look almost risk-free. Fertitta is servicing debt in a higher rate environment, and that constrains the flexibility he'd otherwise have to invest in the properties and the customer experience. The competitive pressure from online gambling is not going away. The U.S. online gambling market hit $12.68 billion in 2024. Every year, that number grows. Younger generations, as one industry analyst noted, have 40 options to gamble on their phones from the comfort of their home. The locals casino model depends on people choosing to physically go somewhere to gamble. That behavior is increasingly in competition with an app on a smartphone. Fertitta will need to think carefully about how station casinos fits into a world where gambling is increasingly digital. Tribal casinos continue to expand across the country and even within Nevada. They operate under different regulatory and tax structures that allow them to offer competitive value propositions. The locals market isn't a closed market. It's a competitive one. And then there's the macroeconomic question. The locals market held up better than the tourist market during recent economic headwinds, that's true. But a severe recession, the kind that hits household discretionary income deeply and broadly, would affect locals' casino spending too. People in financial distress stop driving to the casino on Tuesday nights. They don't stop as fast as tourists cancel flights, but they stop. None of these risks are fatal. They're real considerations that Fertitta, who has navigated multiple economic cycles building Landry's, has certainly modeled. But they deserve acknowledgement because this isn't a guaranteed win. It's a very smart bet. Those are different things. Vegas of all places should understand the distinction. What this means for regular players like us. Here's the question I know you've been sitting with for the last several minutes. Because I know this audience and I know what you actually care about. Not EBITDA multiples, not debt structures, not competitive moats. You want to know if your neighborhood station casino is going to stay the station casino you love. Or if Tilman Fertitta is going to walk in, see dollar signs everywhere, and start doing to the locals market what MGM and Caesars did to the Strip. Honestly, I think the answer is no, and here's why I believe that. Fertitta made his name by understanding what makes hospitality work, not by squeezing customers until they leave, but by delivering value consistently and building loyalty over time. His model at Landry's was never predatory pricing. It was volume, consistency, and operational discipline. You can eat at a Landry's restaurant and feel like you got what you paid for. That's a deliberate choice, not a coincidence. More importantly, Fertitta is buying the locals market specifically because it works. The entire thesis of this deal is that the locals model, done right, generates sustainable, profitable growth. If he comes in and starts raising table minimums to Strip levels, tightening the slots, eliminating free parking, adding resort fees, he destroys the very thing he paid $31.5 billion for. That's not a smart operator. That's the kind of self-defeating behavior that's currently causing 11.3% visitor declines on the Strip. Fertitta watched that happen. He's not going to replicate it. That said, expect some changes. He will standardize. He will optimize. Some costs will be cut in places that don't face the customer. Some things that seem inefficient might disappear. That's what private equity-backed operators do, and Fertitta is nothing if not disciplined about cost. But the compact with the local player, the free parking, the reasonable table minimums, the slot floors that give you a fighting chance, the restaurants where $30 doesn't get you 3 pancakes and a look of contempt, that compact is the product. And Fertitta knows it. The people who built station casinos understood something that Strip operators forgot. If you treat people well, they come back, every week, for 30 years. And that's worth more than any whale you'll ever fly in on a private jet. The bigger picture, a changing of the guard in Vegas. Step back from the specific numbers for a moment and look at what this deal actually represents in the context of Las Vegas history. Because I think this is genuinely a changing of the guard moment, and we're going to look back at this in 10 years and understand it as such. The era of the Strip as the center of gravity for everything Las Vegas represents may be quietly ending. Not collapsing overnight, not disappearing, but shifting in ways that the corporate operators who've been running the Strip haven't fully reckoned with yet. Visitor numbers are falling. Regular players are being priced out. The iconic free attractions that generated the electric atmosphere of the Strip, the volcano at the Mirage that mesmerized people from the sidewalk for 35 years before being demolished in August 2024, the pirate battles at Treasure Island that ran for 20 years before being shut down, the buffets where a construction worker from Ohio could eat alongside a Manhattan millionaire, all of it systematically eliminated in pursuit of a high roller model that the economics increasingly don't support. Meanwhile, in the suburbs, a different model has been quietly proving itself right. The model that says volume matters. The model that says loyalty is earned by delivering value, not demanded through monopoly pricing. The model that says the person betting $25 at a blackjack table on a Wednesday night is worth cultivating, not eliminating. Tilman Fertitta, putting $31.5 billion behind that model, is the loudest possible vote of confidence in that direction. This isn't a casual bet. This is a conviction bet from one of the most successful operators in American hospitality history. Las Vegas was not built by high rollers. It was not built by whales or trust fund kids or Australian billionaires betting millions per session at the Bellagio. It was built by regular people, by the millions of working and middle-class Americans who saved up their vacation money, drove in from California or flew in from the Midwest, and spent a long weekend feeling like the rules of ordinary life were temporarily suspended. And for the people who actually live here, the 700,000 and growing residents of the Las Vegas Valley, this city was always meant to be more than a tourist destination. It was meant to be a city, a real one, with neighborhoods and neighborhood casinos, where people felt welcome not because they were spending enough to justify a private jet transfer and a complimentary penthouse, but because they showed up, consistently, year after year. Tilman Fertitta is betting that city still exists. Honestly, after everything we've covered on this channel, I think he's right. Have you felt the difference between walking into a station casino and walking into a strip property lately? Have you noticed that the locals market still treats you like a customer worth keeping, while the strip treats you like an inconvenience between it and its next whale? Because your experience matters more than any earnings report, any analyst note, or any $31.5 billion press release. The people who actually live in this valley and actually play in these casinos are the ones who know whether this deal is going to deliver on its promise. We're not here to repeat the corporate talking points. We're here to tell you what's actually happening to this city, deal by deal, casino by casino, until someone in a boardroom somewhere remembers who built this town. It wasn't them. It was us, and it still is.